Welcome to this explainer. Today we're diving deep into CG Power and Industrial Solutions' March 2026 financial report. We're charting their explosive growth and, honestly, their incredibly bold pivot into tomorrow's technology. It's a fascinating story of how a traditional manufacturing powerhouse is reshaping its entire future, and we're going to understand exactly how they're doing it by looking straight at the data. Here's our roadmap for this explainer. First, we'll look at the big financial picture. Then, we'll check out their core engines, power and industrial. After that, it's on to the semiconductor pivot, and we'll wrap things up with their fundraising and strategic moves. Let's get right into Section 1, the big financial picture, auditor trust and surging revenues. So, we're starting off with a really vital foundation. The statutory auditors, SRBC & Co. LLP, actually issued an unmodified opinion for the year ended March 31st, 2026. Basically, this is a clean bill of health. It means we can absolutely trust the numbers we're about to dig into. Now take a look at this. The year-over-year surge is just dramatic. We're talking about consolidated revenue leaping from roughly 99,008 crores in the previous fiscal year straight to a massive 12,417 crores in 2025-26. That is a gigantic jump for a legacy manufacturing company. It shows some serious market momentum. And that momentum, it isn't just for show. This stellar top-line growth cascaded right down to the bottom line, delivering a consolidated profit after tax of nearly 1,199 crore rupees. So the business isn't just expanding its sales footprint, it is highly profitable. Now, as impartial observers here, we do have to call out one specific exceptional item. They took a 35.57 crore rupee hit. But, and this is key, this wasn't due to poor operational performance. It was actually an adjustment to comply with the government's newly enacted labor codes, which bumped up their gratuity and leave liabilities. It's just a one-off accounting adjustment, but, it's absolutely vital for getting the full, accurate financial picture. Okay, Section 2, Core Engines, the legacy systems funding the future. Despite all the flashy headlines and the buzz around their new tech ventures, their legacy industrial and power systems absolutely dominate the current revenue mix. Just look at this breakdown. Industrial systems brought in an impressive 6,747 crores, and power systems was right behind it with 5,138 crores. That new semiconductor slice, it's just under 503 crores. So traditional heavy industry is still very much the beating heart of CG Power. Crucially, these legacy engines are cash cows. Power systems generated over 1,122 crores in profit before tax, and industrial systems brought in over 625 crores. Why does this matter? Well, because they are easily absorbing the initial 107 crore rupee loss from the brand new semiconductor business. Basically, they have a built-in financial cushion that is directly funding their own innovation. Moving right along to Section 3, the semiconductor pivot, building an OSAT facility and acquiring fabless design. Here we see the true anatomy of this pivot. They aren't just starting from scratch and hoping for the best, they are outright buying expertise and securing massive government backing. First, they dropped over 284 crores to acquire a fabless semiconductor design business from Renesas. On top of that, they're building an outsourced semiconductor assembly and test facility, commonly called an OSAT, and this project is being supercharged by a massive 668 crore rupee government grant. In fact, they already received over 601 crores of that by March 2026. It's a brilliant playbook for bootstrapping a high-tech division. Mix smart acquisitions with aggressive public policy support. And that brings us to Section 4, fundraising and strategic moves, raising capital and trimming international assets. So funding an advanced OSAT facility takes astronomical capital, well beyond what a grant covers. To get this cash, the company executed a QIP, or a Qualified Institutional Placement. It's a clever tool that lets them issue equity shares directly to large institutional investors, helping them rapidly build up a war chest without slogging through a lengthy standard public offering. And guys, the scale here is literally breathtaking. Through this QIP, they successfully raised a 3,000 crore rupee war chest. They did this by issuing over 45 million shares at 660 rupees a pop. It's a massive injection of liquidity aimed squarely at fueling these new technology ventures. What's really fascinating here is how they're actively concentrating their resources.
They're pairing this huge 3,000 core capital injection with a strategic divestment of international assets. They went ahead and sold their Indonesian switchgear subsidiary, CPSI. This move didn't just clear liabilities off their books, it also secured a loan repayment of over 21 crore rupees back to the group. Basically, they're pulling all their capital back home so they can focus entirely on domestic expansion.
But hold on, they aren't rushing to spend it all at once. Out of that 3,000 crores they raised, only about 380 crores was actually utilized by March 2026. The company is being incredibly prudent here. They're keeping the rest of the funds liquid, parking it temporarily in mutual funds and fixed deposits. They're keeping their powder dry, just waiting for the exact right moments to deploy it as the OSAT facility construction progresses.
Which leaves us with one final absolutely crucial question to consider. With 3,000 crores raised and a brand new expanding OSAT facility underway, will this carefully funded pivot ultimately transform CG Power into a global semiconductor giant? Will these legacy manufacturing engines eventually just take a backseat to this new technological frontier? It is a textbook example of legacy profits funding the tech of tomorrow, and it's going to be a fascinating journey to watch unfold. Thank you so much for joining me for this explainer, and as always, keep exploring the data.